Morning.
You said 30% chance of a deal yesterday, and now we get it. Did Saudis cave? Is this the takeaway?
No, our point wasn't a 30% chance of a deal. It was the market was pricing a 30% chance of a deal. Our view was we expected a deal. And one of the key reasons is that the economics, not the politics, but the economics of a deal were incredibly compelling. Aside from the fact that the risks were incredibly asymmetric for them to begin with, the other point is that they had a rebalanced market in the line of sight. So what they had to do was to actually cut production and pull forward an already balanced market. Now, why do they want to do that? The main reason is inventory normalization, not price. And why do they want inventory normalization? They want backwardation. Let me repeat that word, backwardation, backwardation.
Love it.
That's one of her favorites. It's one of her favorites. Well done, Jeff.
So let's actually go over why backwardation is so important to them. Right now, when you look at the shape of the forward curve, or before today's rally, you had 45 on the front end and then 50, 55 on the back end of that forward curve. What did that allow U.S. E&Ps to do? Hedge forward their future production. If they can rotate that curve into what we call a backwardation, where you have 50, 55 on the front end and 45 on the back end, it takes away that ability to hedge.
This is what we mean when we're talking about backwardation, that prices are much more expensive today than they're going to be in the future. What does the curve need to look like for a Saudi deal or an OPEC deal to be successful?
Well, the one thing about curve shape, it cannot price in expectations because it is actually an arbitrage between today and tomorrow. So they actually got to draw those inventories to shift that curve into backwardation. Think about it this way. When you have a contango, your spot prices sit below forwards because you can buy a barrel of oil today, put it into storage, and pay for that cost of storage. When you get a backwardated curve, it means there's a premium for prompt delivery. It means you no longer have excess surplus in the market. So when we think about when you get that curve shape, the only possible way is draw inventories. Now let's bring this whole idea about compliance and implementation. On implementation, because there's tolerance in terms of their contracts they have with refineries around the world, they can just drop into the lower end of tolerance. So the implementation is not that difficult. Now the question is compliance. They have an incentive right now, once they've started this process, take it to conclusion, bring those inventories down, and shift that forward curve into backwardation.
Here's what I don't understand. By your own calculations, inventories are going to draw in the third quarter of 2017. Why this urgency when we're just like 8 months away from it happening anyway?
Because the downside risks were tremendous. Our expectations were the market would trade down into the $43 range on year end and then spend most of the first half of next year around $45 a barrel. By speeding up this process, they take that 43 and 45 price and then turn it into a $50, $55 price environment. That's substantially better for the revenues, but more importantly, it speeds up that process of going into backwardation, which then actually allows them to pursue that market share strategy because it takes away the ability for producers to hedge.
And when you talk about urgency, you have to think about the Saudi budget. I mean, they've been running a deficit, and they've been running down their reserves.
Absolutely.
So there is some pressure on them. At what point is this enough to fix that problem for them?
It's enough to actually give a temporary relief, but I think it goes back to the point that Alex was saying was you were likely to get this anyway in the second half of next year. All it does is it takes away that pain they would have had otherwise over the first 6 months of 2017.
So into the specifics, though, there are a couple question marks. One is Iraq going to agree and Iran going to agree, and what will those agreements be? The other comes from non-OPEC, and Russia coming today said they're going to agree to some kind of cut. It looks like it might be 200,000 barrels of oil a day. Do you believe that? I mean, if they're cutting at today levels that could be actually a net cut of 500,000 barrels a day if you take into account their growing production. That seems a little extreme.
Yeah. Actually, look at historically, the only time you've seen any compliance out of Russia was in the midst of the emerging market crisis in 1998-99, at the latter part of it. So there's not a lot of history for compliance. Our base case is that Russia is a freeze. Same thing with Iran, Iraq. We're not needing heavy lifting out of those three players. So additional cuts from that group would only just reinforce this dynamic. So really, core OPEC is the one we expected to cut production and create that inventory normalization.
How much would production have been coming down anyway? Just because as fields mature, it's harder and harder to get oil out of them, and they start to go off. There's a natural decline. How much of this is just natural decline?
Well, given the fact that we've had a period of low prices over the course of the last 2.5 years, that was another reason why the market was going to rebalance through the second half. The high-cost players groups like North Sea, Mexico, Canada, you were already starting to see significant decline rates. In fact, going back to the economics of a deal, there was really three big drivers behind why we thought a deal was likely to happen. One, a cyclically stronger economic backdrop. Two, decline rates from the high-cost players. But here's another important point. We had a delineation of the cost curve. We knew that line was drawn in the sand somewhere between 50 and 55, given the behavior of U.S. E&Ps. So that, going back to your question about decline rates, is an important part of the rebalancing process.